We are in a fairly good position with this economy, the Fed Reserve Chairman stated in his semi-annual testimony to Congress. At the same time, Jerome Powell noted that the Fed Reserve would not rush into further interest rate cuts, and this is understandable. Neither the scale of Trump's tariff sanctions nor their consequences can be predicted at this point. Interestingly, the cautions Powell carefully avoided the topic of tariffs altogether. At the same time, investors are on edge due to the actual start of the US tariff war against the whole world. However, this factor seems to be losing its meaning as a driver for the US dollar. Even the Fed Reserve's intention to keep interest rates high for an extended period has not had a positive effect on the US currency. The dollar index against its 6 major partners opened on Wednesday in the red, fluctuating within a narrow range of 107.90 to 108.10. What has changed? Confidence has given way to doubts. Donald Trump had promised to implement many reforms literally on his first day in office. More than 3 weeks have passed since then. For now, the strength of the US economy remains intact mainly due to the achievements of the previous administration. As for the tariffs that the new US president is relying on so heavily, they could actually slow down GDP growth in the US economy. In fact, this was exactly what happened during Donald Trump's first presidential term, as shown on the chart. Moreover, the weight of his words seems to be diminishing. For instance, the initially announced 60% tariffs against China have turned out to be only 10% in reality. Similarly, the 25% tariffs on steel and aluminum were originally declared to apply to all imports without exceptions, regardless of the country of origin. However, an exception has already been made for Australia, and today Japan's government has submitted a similar request to Washington. Meanwhile, the European Union, along with Canada and Mexico, condemned this move and warned of harsh and proportional countermeasures. In reality, all these tariff threats could ultimately lead to mutual settlements, but the trust in the US economy may be undermined. Interestingly, the popular trade strategy of shortening the euro has not yielded significant profits this year either. It's possible that Trump trading is starting to fade. As this narrative weakens, bearish traders in the euro-dollar pair have begun questioning. Was it really worth selling the euro so aggressively? These considerations provided some support for the risk assets in the euro today. However, talking about a significant correction in the dollar right now also does not make much sense. As a result, the euro-dollar pair remains trapped in a consolidation range of 1.0357 to 1.0387. The market was waiting for the US inflation report, which turned out to be another disappointment for euro bills, as it reinforced not only the interest rate gap between the Fed Reserve and the ECB, but also the likelihood of further rate cuts. While the Fed is expected to hold its purse, the ECB might implement as many as 3 rate cuts this year. As a result, the euro-dollar pair resumed its decline, with the potential target below the technical support level of 1.0195. Given that the Fed Reserve Chair stated their willingness to cut interest rates if inflation continues to decline, the fresh inflation report helped clarify this scenario to some extent. It showed that in January, the US CPI rose to 3% in January, and this figure indicates stealth progress in curbing inflation in the American economy and gave the dollar a fresh boost. Also, this week, we recommend paying attention to the US Producer Price Index, PPI, available on a Thursday, and the January retail sales data, which will be published on Friday. You can find more details about the release times of these and other economic statistics, as well as the potential impact on the markets, in our Traders Calendar. Today, the economic calendar contains OPEC's monthly oil market report. Meanwhile, oil prices have retreated from recent peaks, which were driven by concerns over supply disruptions from Russia and Iran. Now the market is reacting to data from the American Petroleum Institute. US crude oil inventories increased by 9.043 million barrels last week. Oil stocks have now reached the highest level since March, so it's possible that traders have decided to lock in profits. As a result, Brent crude is trading lower today within the range of $76 to $77 per barrel. Besides, the trade war explained by Donald Trump could negatively impact global economic growth, which in turn may reduce oil demand. For now, the only bullish factor for oil traders remains the political news cycle. If regional conflicts escalate, supply disruption risks may rise. Furthermore, at any moment, the US president could make another statement regarding trade tariffs or geopolitical issues. Today, the Russian market aligns with the global trends. The Moscow Exchange Index closed above 3,000 points for the first time since July 2024, while the ruble is preparing for Friday's release of inflation reports and the Bank of Russia's interest rate decision. The CPI is expected to rise while the central bank's key rate is likely to remain unchanged at 21%. Additionally, the positive news backdrop suggests that the geopolitical tensions will calm down. As the market anticipates the end of the key rate hikes and geopolitical, so the ruble is testing its 5-month highs. As a result, the dollar-ruble pair dropped below 95 today, while the yuan remains above 12 rubles. The ruble also owes its growth to solid supply and weak demand for the foreign exchange. Experts suggest that ruble stabilization may last until the end of February. And that's all for now. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. See you soon.